The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A better than good inflation report pushing bond yields down and lifting small caps up. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Is this a tech sell-off we've been waiting for?
I don't know. It's certainly a rotation, that's for sure.
Yeah, no doubt. Let's take a look at it here because you're looking at an S&P is down by about 0.8%. We're off the lows, but just barely. The Nasdaq 100 down by about 2%. We haven't seen this kind of sell-off since October of last year. In fact, it's been 48 days since we've had all the Mag 7 down on one day, and that's exactly what we're seeing today. Now, where's the money going? Definitely going into the bond market, particularly in the front end. You have yields dropping there by about 11 basis points, 9 basis points on the long end, and it is going to the yen. Dollar yen down almost 2%. Romaine, the question has been, is the MOF in the market? Did they wind up selling the dollar aggressively once we had that CPI? But regardless, you're seeing that heavy dollar trade as we're pricing in more of those cuts.
Yeah, we talk about the seeds of the complexion of what we're seeing right now, and that was seeded earlier this morning on the back of that U.S. inflation report, a cooler than expected U.S. inflation report that injected another dose of confidence that the Fed will have no excuse not to cut rates. That confidence reflected in the double-digit basis point declines that we're seeing in short-term yields and the widest outperformance all year long for interest rate-sensitive stocks relative to big tech. However, whatever relief you see reflected in the Russell 2000 and in U.S. Treasuries, that sentiment of sort of we're finally out of the woods, that sentiment is far from universal. ConAgra Foods reporting earnings saying its cost of goods sold continuing to rise, and Pepsi saying snack sales volumes are lower as budget-conscious shoppers trade down. David Kelly and Mizuho's Steve Risciuto, they weighed in earlier.
I don't see any reason why we should be headed for recession here, but we are seeing that slowdown in growth.
Is the economy going to stay a trend, or is it going beyond that? That's now the question they have to answer.
A delicate balance right now, and of course we saw that with the earnings out of ConAgra and Pepsi. Inflationary concerns also dragging down airline stocks. This after Delta said rising labor and maintenance costs are eating away at its profit margins, even, Alex Steele, with passenger traffic at record highs.
No, I'm not seeing the flight discounts, let's be honest.
I'm certainly not seeing them.
Right?
Yeah.
Okay, so let's go to the Fed funds rate. So this is a great chart that shows the rate expectations in the market for September, November, and December. So December is the yellow line, November the blue, and September is the white. What I want to point out here is the December line. So now we're looking at about 57 basis points of cuts so far for this year. So that implies 2 cuts now fully priced by the end of the year. When do we get them? We are almost fully priced now for 125 basis point cut for December, definitely in November. And you can see just how extreme the movement was after we got that lighter than expected CPI. And also so interesting, Romaine, in some ways that was priced into the equity market, in some ways, just not the bond market. But now we're seeing JP Morgan, for example, now seeing a cut in September instead of November.
Yeah, a lot of people really now doubling down on those bets on the back, of course, of encouraging CPI report. Data, of course, that did show inflation cooling broadly in June, driven by a long-awaited slowdown in housing costs. The number sending the strongest signal yet that the Fed might move to cut interest rates soon. Michael Gapen joining us, head of U.S. economics at Bank of America Securities here. It's a bet people in the markets are making, and we're hearing the same out of strategists. Michael, are you on board?
Not entirely. I mean, certainly we're completely on board with the idea that this is unambiguously good news for the Fed, and it's unambiguously good news for the outlook that the Fed will be cutting. So a deceleration in shelter, a deceleration in non-shelter services, and another month of decline in core goods. So it's all good across the board. As you said, a better than good report. And we would just say, though, the translation into PCE isn't all that favorable. And I'm not quite as negative on activity as I kind of hear Fed Powell was in front of the Senate. So we're still thinking the first cut comes in December, but certainly today's data brings September much closer to the baseline than it was before.
Are you seeing, though, a bit more equilibrium in the economy? And this is something that Powell was asked about and responded to over those 2 days of testimony. And, of course, he made it clear that he is starting to see a little bit more balance. And I'm wondering, does that work in favor of the Fed actually doing nothing for the foreseeable future?
Yeah, certainly we see more balance, and the evidence is suggesting the economy is cooling. I think the question is, does it meet kind of the Fed's nebulous bar of, quote, unexpected weakening in either the labor market or the economy? We don't think so. So it would still kind of foretell gradual rate cuts in in front of us. But the economy is cooling, and the Fed's messaging on this front has changed. The dual mandate is back. It's no longer a singular focus on inflation, but it's also concerns about a cooling economy. So the Fed has kind of two paths to easing right now. One is inflation is in line with what they think. The other is the fact that we want to ease to preserve the expansion. So it's not just inflation anymore. It is about inflation and a cooling economy.
What do you expect from PPI tomorrow, Michael? And I say that because there was a great piece out on the Bloomberg that talked about how producer prices and inflation in China is starting to maybe pick back up a little bit. And we have seen PPI here start to rebound.
Yeah, and as I think you noted with some of the firm's earnings calls that you were referring to, that there's a tension here on the goods side of the economy. So yes, the consumer goods data was soft on the month. That's mainly an auto story. But there's a risk around goods prices that shipping costs have moved higher again. Will that show up in higher producer prices? So I still think that that's a concern out there. But again, from the Fed's perspective, the idea here was that, hey, we need more evidence that services inflation is decelerating, because we know goods price deflation will end. So having shelter take a step down before we get indication that goods price payback is over, I think that's still very favorable on the expectation that the Fed will be cutting. So our view on PPI is very similar to the market on this one. We'll see how it comes in terms of PCE, but it seems like we're set up for a 0.2 on PCE inflation, at least at the core level for the month of June.
I know you're the eco guy, not the bond guy, but just with a 2-year down 11 basis points and a steeper curve, do you feel like this is the correct reaction? Are we overdoing it at all, doing the Fed's jobs for it before they have to?
No, I think it's the right response by the market. And I would just say, remember, if the economy is cooling and the evidence is pointing to a deceleration in employment, markets price distributions of outcomes. So the market will say, yeah, there's some risk. People like Mike are wrong, and it's not just a cooling economy. There's risk of a more abrupt slowing and greater recession risk. So the market, I think, will tend to price a little more cuts than the Fed expects to deliver. And so that rally in the front end, I think, is also giving you some of that flavor. I think it's completely reasonable given what we know.
And we sort of, as we wrap up this conversation, Michael, there's been a lot of discussion as we look a little bit further out into 2025. The idea here that what we've gotten so far in this disinflationary trend, whether that did come directly from monetary policy or whether it was more just some of those structural issues that sorted themselves out on their own, who knows? How does fiscal policy, if at all, complicate the situation, particularly with the huge supply of debt that's continuing to come out the pipe?
Yeah, here I would remind, at least our view on this anyway, is that major changes to fiscal policy, may be dependent on sweep outcomes, but they're also dependent on the fact that the Tax Cut and Jobs Act doesn't expire until the end of 2025. So any budgetary negotiations and change in fiscal and tax policy may not happen until late 2025. So their effect on the economy and activity may not be until, say, 2026 and beyond. Doesn't mean markets won't react in advance to that. But what I'm suggesting here is I'm not convinced that fiscal policy changes will affect the near-term path for inflation. By the near-term path, I mean kind of inflation through the end of 2025, based on fiscal policy expectations alone.
All right, Michael, always great to catch up with you. We'll let you get back to work. Michael Gapen, head of U.S. economics at Bank of America Securities, kicking off the show with a closer look at what's going on in CPI, the market reaction to that in just a minute, as well as a look at some of the big movers on the day, including Delta, having its worst day going all the way back to January of this year. Excess capacity, heavy discounting, and elevated labor costs dragging down that airline as well as its peers.
All right, plus you got Pfizer saying it is moving forward with a weight loss pill to compete with injectable drugs like Ozempic and Wegovy, but there are many questions surrounding that drug. We're going to get the latest.
I wonder if that's having an effect on Pepsi. They came out with earnings and it was weaker than expected, particularly on the revenue side. Volumes for snack food down, particularly for that Frito-Lay business. A discussion about everything ailing the consumer staples sector as well. That's coming up next, right here on The Close on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
All right, 50 minutes until the closing bell. It's rotation nation underway here. Sell tech, buy small caps. That is the trade of the day. NASDAQ 100 at one point having its worst day since October. The Russell's up over 3%. Joining us now is Anastasia Amoroso, Chief Investment Strategist over at ICapital. Anastasia, thank you so much for joining.
Thank you. Good to see you.
Is this the tech sell-off we've been waiting for?
Yes, I think so. And it really shouldn't surprise people given how overextended tech has gotten. But obviously you needed a catalyst and we got a perfect one. And look, it makes sense that, tech has seen a lot of multiple expansion. It is fully accounted for, I think, the earnings potential, which is much more so greater than the S&P. But at the same time, now you have a perfect catalyst for small caps and utilities and other rate sensitive sectors like REITs, for example, which is the Fed rate cuts. And so I'm not at all surprised to see the rotation. And in fact, we've been seeing hedge funds that have been actively selling tech starting in June and continuing in July. And I think there's much more to that trade.
Why is now the time where small caps will be rallying for real and not just a fake out?
Well, growth has been okay and growth has been strong, but that was not enough to support small caps and the other parts of the economy. The reason being is there's a lot of leverage embedded, for example, in some of the smaller cap companies. There's a lot of leverage embedded in real estate, and what they really needed to perform are those rate cuts. And now with 90% probability of September, I think that's what makes it real.
Well, I'm interested in that correlation too, because there's a reason why you're seeing the Russell up 3%.
Yeah.
And I thought about that because everyone was saying, okay, the rate cuts were going to be the salve. Now, we're not necessarily getting them, or at least the Fed hasn't said we're going to get them.
Yeah.
But you have a bond market repricing for that right now, and presumably, at least for one corner of the equity market, also repricing to that.
I personally think the Fed is running out of excuses to not cut interest rates at this point, because not only do you have inflation that is clearly cooling, we got some great numbers within the print, whether it's on Supercore, whether it's just the monthly pace and the fact that it's annualizing at 1.1% over the last 3 months. So the Fed doesn't have the excuse that inflation is not coming down. It is. The Fed is also looking at the labor market, and there's clearly weakness that's emerging. And of course, Fed Chair Powell did admit this week that the labor market is in full balance. So what are we waiting for, especially when the economy is slowing down? So, to Alex's point, again, that's what makes it real to me this time around. And when it comes to the market and kind of going back to the tech trade, the market prices this in advance. Part of the reason why we've rallied as much as we have this year is because we've been sniffing out those rate cuts. But what's interesting is the rotation that we're seeing is exactly what we have seen historically. Tech rallies into the first rate cut, then it consolidates in the 1 or 3 month period. But what tends to outperform are those interest rate sensitive sectors, and actually utilities ends up being the top sector in the 3 month following the first rate cut.
So if you haven't already sort of made either short-term tactical positioning now or even longer-term reallocations now, do you do that now, or do you wait till we get maybe a more clearer signal from the Fed that they're ready to start?
I think you go. I think you make some of those fine-tunings, along the periphery. Look, I'm not going to recommend to sell tech and never going to go back to it, because clearly tech is where the secular growth is. But you do want to probably trim, given how much tech has rallied. And we've seen some notable moves in those small caps and utilities and REITs. But if you zoom out and if you look at the longer-term chart, all of those sectors are coming from either a period of consolidation, underperformance, or even negative performance here to date. So I think this uptick that we've seen is just a start of a move that could last 3 months or longer.
What about earnings? Earnings bar seems to be set pretty high, 8% earnings growth, particularly when it comes to large cap tech.
Yeah.
How would you be thinking about playing earnings season when we heard from Pepsi, right? Top line is struggling, margins are suffering.
Yeah. I think you want to be cautious and a little bit defensive going into the earnings season because, Alex, on average, you do typically get a 3 or 4% earnings downgrade going into the quarter. The bar gets reset lower, and so therefore it's easier to beat it. But that's not been the case this time around. We've seen a 0.5% downgrade to earnings. And so I think there's this sense of, a lot of optimism and exuberance against the economy that it's actually slowed quite a bit. In the beginning of the second quarter, we were looking at 4% nowcast Atlanta GDP. Now we're looking at 1.5. And is that fully reflected in those earnings expectations? Probably not. So I do think we're likely to see a lower earnings surprise and therefore a market reaction that's more muted. So as you can tell, I have a more cautious tone on the markets overall. And it's interesting because we got to be careful, I guess, what we ask for. We've asked for the rotation, but it's here, it's now, it's playing out. Tech is selling off, but the market in aggregate is actually down.
Yeah, and it's a bit interesting to see whether this sticks once we get through earnings season and actually see the cards held not only by those large cap names, but the small cap names as well. Anastasia, great to have you here on the program, Chief Investment Strategist over at ICapital. And we talk about that rotation and sort of what keeps us sustained. I mean, I feel like we've been here a few times this year before where we kind of saw the great rotation and it lasted for like a week or less, and then people just flocked back. But maybe this time is different. Maybe we will finally get that equilibrium that Jay Powell talked about.
It's a fine line, right? Because if the economy slows too much that you really need those cuts, then that should be overall a negative thing. But if it slows just enough to get some cuts, that's helpful.
Yeah, this is
tight roping.
Goldilocks, right?
Oh.
Are we not? Is that a banned word?
No,
now?
I don't think we can say that.
All right, coming up here on the program, a closer look at the big movers on the day. Airline stocks having one of their worst days of the year. This after Delta gave a weak outlook about summer travel. We're going to have more on why the airline says it's struggling to fill its airplanes. That's coming up next here on The Close on Bloomberg. All right, time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start off with Costco. Bank of America saying that hike in the company's membership fee, music to their ears. The firm bumping its price target to $9.62 from $8.74. The big box retailer's first membership hike in 7 years. And analysts say customers are getting used to some of those higher prices. Nevertheless, the shares down significantly on the day by about 4%. Next up, Garde. Jefferies downgrading that stock to underperform. The analysts say the operator of Olive Garden could lose share if that squeeze on customer wallets continues to force the casual dining sector to rely more on promotions. The price target also lowered to $125 from $154. The shares, though, rising higher on the day. And finally, let's take a look at Spotify. A day after Redburn downgraded the stock to sell, Jefferies upgrading the stock to buy. The analyst at Jefferies says it's his top audio streaming pick, and he says he's increasingly confident in the company's ability to deliver sustainable revenue growth from, get this, price hikes. And he says there's room for those hikes at least every other year. The shares, though, down about 1.5% on the day. And those are some of our top calls. We want to turn now our attention to another stock that's been moving today, and that is Delta. Shares of airlines down, with Delta leading the charge here after it reported an outlook that disappointed the street. Sheila Kahyaoglu joining us right now. She has a buy rating and a $56 price target on the stock. Sheila, we got to talk. I don't know what's happening, but I felt like a couple quarters ago, these airline CEOs were telling us everything was great. They're heading into the summer travel season, and they were going to be at full capacity. We see Delta's numbers, capacity the number of passengers slightly below capacity, and they're complaining about their own costs. What's going on?
So I think that tells us the story here, right? Delta's earnings were in line, revenues were in line, costs came in line. The stock is down 5%, the group is down as a whole. This group trades at 5 to 7 times earnings, 60% discount to the market. And what's happening is that Boeing's not delivering planes. On top of it, we have too much capacity somehow. Even though Boeing and Airbus are short of their delivery targets, the U.S. domestic market has too much capacity. Domestic pricing in the U.S. for Delta was up 4% for main cabin in Q1. It decelerated to 0 in Q2. And that consumer softness is what's causing the decline in the share price, I think. And in Q3, it gets even worse. So that's the bottom is Q3. Premium's holding on. Premium's up 10% in Q1, up 10% year over year in Q2.
It was interesting, though, that Bastian talked about heavy discounting. Those are his words. Just anecdotally, as someone who travels a lot, I've not seen that discounting, so I'm not exactly sure where that's happening. But is this something that investors should be paying more attention to?
It is happening in the U.S. domestic market, not transatlantic, where pricing is still solid, Pacific as well. But U.S. domestic, low-cost carriers, Southwest, Frontier, Spirit, are not in a good position. They're dumping excess capacity. So one of the things Frontier did in June was open up a route JFK to Atlanta. Now, you can't compete with Delta on that route unless you're pricing it for $50, So they're being bad. There's bad actors, and capacity is only up 4.5% year over year in the first half. That exit rate in September is up 3%. So Delta is basically telling us that capacity is going to get rationalized in the second half. I'm not sure I'm a buyer of it. Neither is the market, and that's why the stocks are trading down.
Also, you fly business, first class. That's the problem. This is the economy that's seeing the pressure. You just got to go down the cabin. That's a whole different story.
I peek beyond the curtain, see how the other half lives.
That's how that is. What part of this is also just tough comps? Because last year and the year before were just so good with all the revenge travel.
A little bit tough comps. You're seeing that more in the Atlantic market where it's just evening out. But in the U.S., I think it's really, it's hard to distinguish how much is the consumer softness versus how much is the bad actors in the market.
So if we're going to live in a world where airline travel will now match GDP rather than exceed it, how much do these stocks have to re-rate for that?
They're not going to re-rate because they're at the lows. I think they must.
There's no more re-rating.
They're at rock bottom levels when it comes to multiples for the airline group. So there's no re-rating, and that's what United and Delta have really argued for, is that they could sustain these earnings. I mean, they're still doing 13% margins even with a bad actor. So they're not bad companies, but they're not going to be able to re-rate higher or even trade at a 50%. 25% discount to the market because they're being seen as cyclical and the rest of the industry isn't completely rational.
We'll talk about the cost issues. This also came up on the conference call. Of course, we know the labor costs were higher because of the new contract, but he also said maintenance costs were up as well, and he cited a couple other things that are escaping right now. Is that going to be an issue for the other airlines when we get their reports?
Costs are okay, actually. Surprisingly, maintenance costs were up 11%, and you're seeing the aftermarket stocks go down because maintenance costs in the second half for Delta are up only low single digits. But basically, everybody's trying to put capacity into the air to get as much profit as possible because pricing is down. So I think cost story is okay for the airlines for now. The bottom line is pricing. Pricing has been deflationary for the last 20, 30 years. And this is proving another year where you could get airfares cheaper than you did in 2019. And you can't say that for a lot of industries. And then what happens when Boeing comes back? Eventually, Boeing's going to get its act together and deliver planes to Southwest and United. Eventually. And then we have more capacity, and so then you could see others cut pricing even more.
Then we'll maybe see cheaper prices for domestic internet. Okay, all right, fair enough. Sheila, thanks a lot. We really appreciate it. Sheila Kahyaoglu, U.S. equity research analyst over at Jefferies. Because I'm with you, I do not see the lower fares at all when I'm booking.
When I saw the heavy discounting comp, I was like, okay.
Let's get to it. All right.
But I think Sheila made a good point too about the competition. I forgot about the Frontier thing, and I know I wouldn't be caught dead on Frontier or Spirit, but I know a lot of people who do fly those airlines, and there's a reason why they're booking tickets right now because they are getting them for $100 to go halfway across the country.
Right. So there is something for that. All right. Well, coming up, we're going to have another story here for the Pfizer's plan to introduce a weight loss pill.
A pill.
A pill. Once a day pill. That's better than a shot. Yeah. We're going to discuss that. The questions surrounding the drug, what it actually means, and how they wind up building it up. We're going to dissect that next on the close. You're still looking at a pretty heavy sell-off now in the tech market here. Nasdaq is down 1.7%. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Dia. Looking at these markets, I mean, there are some heavy volume trades taking place, particularly within the airline stocks. I think American Airlines trading at $10.
Yeah, the drop in airline stocks is pretty severe, but I feel like this is kind of an own goal for them because all those CEOs, they were talking up how great this summer was going to be just a few months ago, and now we see the numbers, at least for the second quarter, and maybe they got a little ahead of their skis.
Maybe. Some of the stocks that are doing really well, that are having some heavy volume here, one of them is Pfizer. Moving higher, up by over 1%. Drug company saying it's moving forward with a weight loss pill to compete with injectable drugs like Ozempic and Wegovy. Joining us now is Bloomberg healthcare reporter Damian Garde joining us. Hey, Damian, walk us through what this means. Meaningful progress moving forward. What does that mean for this kind of pill?
So basically what we learned is that Pfizer is going to press on with what would be, as you mentioned, a pill that would ideally replicate the effects that you see in injectable medicines that are already available. It's somewhat of an incremental story because basically there was concern that Pfizer would pull the plug on this project because earlier trials suggested it might have a side effect profile that would make it not really tenable for the market. What Pfizer said today is that they kind of went back to the lab, retooled the pill a little bit, and have come up with a version that they feel comfortable pressing forward into clinical trials. It's important to note it's still probably years away from FDA approval. They need to do now a mid-stage study to determine the right dose, and then that would lead to the final stage of development that would actually generate data needed to get it on the market.
Well, so just kind of explain that for viewers here, Damian, with regards to the difference between an oral medication and an injectable, like you see with Wegovy, Ozempic, Mounjaro. There's a reason why there's concerns about side effects, because in theory, that pill, it would have to be a higher dose to get the similar effect of an injectable. Is that kind of how it works?
Essentially, yes. So it would be taken once a day, whereas the injectable medicines are weekly. And so the potential advantages there, I think there's the obvious one of many people would prefer to take a pill rather than inject themselves with an under-the-skin needle as the current product would require. But also, it's important to note that Wegovy, Ozempic, Mounjaro, these are drugs that are technically in shortage in the United States, at least. It's very difficult for these companies to make enough of it to supply the demand that exists. If Pfizer were to succeed in making a pill, that's something that conceivably it could crank out much more easily and more cheaply. Pfizer, a company that, in its heyday in the 1990s was making Viagra and Lipitor tablets by the millions. And so if they can succeed in this process, they could conceivably not only offer a comparable and cheaper product, but one that would be easier to supply around the world, where getting the auto-injector pens that have to be maintained in a refrigerator is much more difficult for Novo Nordisk and Eli Lilly.
So my question is, why is the stock carrying so much? Like, this isn't a cheap biotech stock, right? Why does the market care so much about this, even though this could be years away?
Right. I mean, that in itself is kind of an indicator of how far Pfizer has fallen in the estimation of investors, really, since COVID-19. This is a company that was making record revenue from its vaccine and pill for COVID just 2 years ago. But as demand for those products has really fallen off a cliff, so too has their stock price, and so too has, I think, Wall Street's approximation of their pipeline. There's not a lot in there that investors seem to be excited about. So this oral obesity treatment, even though it is only in the mid stages of development, has generated, I think, outsized scrutiny in the Pfizer story, just because people are looking for something to conceivably move the needle with respect to revenue in the years to come.
All right, Damian, great stuff here. Bloomberg Health Reporter, a closer look here at Pfizer's efforts to create an oral version of some of these GLP-1 drugs, Alex. And of course, if we do sort of get that sort of mass production like he talks about and makes this available to everyone, then doesn't this start to become an issue for some of the food companies? I mean, everyone talks about it's not an issue now because there's some small percentage of folks on these drugs now, but if it's just a pill that anybody can get pretty easily.
I mean, if you ask Novo Nordisk CEO, even just like 6-10 months ago, he'd say, yeah, he's getting calls from food companies, really worried about it.
Yeah, and I've heard the same thing. In fact, I actually had a chance to spend a couple of days out at the headquarters of General Mills, where I asked them about the popularity of weight loss drugs and whether they were concerned about losing sales. I caught up with the CEO, Jeff Harmening, as well as the CFO, Kofi Bruce, on the new edition of Bloomberg's Chief Future Officer Show. Take a listen as to what they had to say about this.
General Mills can trace its history back to a single flour mill built in 1866. The company officially formed in 1928 through the combination of several competing mills. Since then, it's grown and thrived by anticipating challenges and quickly adapting.
We've been successful because we've changed, not because we failed to change.
Right now, the entire food industry is dealing with a novel challenge, the rise of weight loss drugs like Wegovy and Zepbound.
The interest in weight loss drugs is here to stay. We survey consumers and see consistently that 30% of consumers are interested in weight loss drugs.
There's not an impact on our business today, positive or negative, frankly, with the weight loss drugs that have been launched. As you look over the next decade, most experts would say there'll actually be a minimal impact.
You're not making any major changes to the business specifically around the weight loss.
We have not made any major changes to the business at this point, nor does it warrant it.
In the center of disruption is always opportunity, right? So yes, it's a risk, but it's also an opportunity to differentiate. We don't necessarily get to pick the macro factors that impact our business. Our job is actually to figure out how to respond to them.
And you can catch the full episode of Bloomberg's Chief Future Officer across all of our platforms, including our YouTube channel that airs every Wednesday night right here on Bloomberg Television. A whole slate of these shows coming up. Alex, of course, this is the kickoff for the new season. And we, as you can imagine, we talked a lot about weight loss drugs, GLP. And as you can imagine, they were a little defensive and kind of saying, look, this isn't a big issue. But they did acknowledge, as you said, they wouldn't tell me who, but they said, yes, they are in contact with these drug makers. They kind of want to know what's the uptake, how fast is this going to go, but they're confident that they can adapt to whatever changes this has on how we eat and what we buy.
Isn't the whole thing, though, too, is that you have to keep taking these drugs, that it doesn't actually change it 100% forever? So at some point, maybe you stop snacking for whatever, 2 years, but then you're going to go back at the end of the day? That's the question?
Yeah, and I asked them about that, right, the idea that these are sort of forever drugs, and maybe that sort of ends up working to their advantage. Look, here's the company line. They're basically saying, look, we follow the trends, and if the trends end up where people are on these drugs, eating less or eating differently, they'll adapt their product lineup to fit what that trend is. Now, whether you believe that or not remains to be seen.
Did you get free snacks?
We did the whole test kitchen thing. It was like, they were cooking and baking and doing everything for us. It was a lot. Yeah,
that's really fun.
I need some Wegovy after I got done with them.
Fair enough. And speaking of, we're going to talk about Pepsi next. So their shares are on the move. The company did report sales that slumped, signaling consumers are cutting back on snacks. Yet that stock is up on the day. We'll kind of get into that. It's today's stock of the hour. This is the close on Bloomberg.
All right, it's time now for our stock of the hour. Keeping an eye on shares of Pepsi. The stock actually opened lower earlier this morning, now basically straddling the line between gains and losses. Some concerns here about weaker than expected revenue growth in the most recent quarter, as its snack food business was hurt by increasingly budget-focused shoppers. Joining us for more insight on the quarter is Barclays analyst Lauren Lieberman. She has an overweight and a 180 price target on the stock. And I don't know if you've been watching the stock moves, but it's kind of fitting. This was a stock that opened lower by about 3% and then kind of steadily climbed higher. It was in the green for a while, now unchanged. But it seems like this is that push and pull where some investors are looking at that top line revenue number. They're really disappointed. But some folks are looking at that bottom line and the margin capabilities that this company has. And they're saying that there's still some daylight here for this stock to move higher. What side do you stand on?
Yeah, I think you've captured it perfectly. The one thing that you're missing is that expectations coming into today were the top line would be weaker. People track the Nielsen data or Circana data very, very closely, and it's been apparent that the Frito-Lay business has been under pressure. So where do I stand? I am of the view that betting against Pepsi over the long term, generally not a great idea when you think about the resiliency and the strength of this brand portfolio. And as you said, the ability to go after productivity. So as we get into the second half of the year, the plans that they are beginning to articulate and put into action to turn around the Frito business are significant. So I think we're going to see pretty quick change. There really seem to be lighting a fire under the frontline sales force. Their DSD capability is really distinct. And to get into the market and drive that activity.
But what is it that they need to do here? And I guess it kind of, let me reverse engineer that question. It's kind of, what's the problem now that they need to solve, particularly when it comes to snacks? Is this a pricing issue, or is this more about better promotion and better visibility in storefronts? What do they need to do?
A little bit of both. But the core of it, and they said it themselves, it's an issue of value. You have an increasingly value-seeking consumer. And there are pockets of this portfolio where prices have just gotten too high. And they were very quick to point out that any adjustments they make will be surgical, will be tactical, all sorts of language like that. But where they have started to promote more heavily, as they put it, hot price points, they're seeing the volume start to move. But there's also elements of the portfolio, like the more premium end of the portfolio, where it's growing. Things like Sun Chips and popcorners and things that are a little bit more expensive and, quote, more permissible. Those have still been growing, and they're going to invest more in marketing and, like you said, availability and visibility.
What do you care more about, Lauren? Is it going to be top line and sales growth, organic sales growth, or is it going to be their margins?
Well, it's both.
You gotta pick.
We analysts, we want it all. But I do think what's going to drive the stock long term is top line. I mean, it's a consumer staples company, and what drives the long term premium valuation for companies like this is the brand equity value and the idea that over, you look out 20, 30 years from now, you expect these brands to sustain. Frito-Lay margins in particular are very, very strong, and I do think there's wiggle room in this model for them to make the choice to invest, to prioritize top line growth over margin expansion in that business in particular.
So we hear a lot about the value war in fast food, and it feels like we're going to be in a value war situation potentially with the snack guys. So based on that, what does that look like on a price level for like a Pepsi and a Coke, for example?
Right. Well, remember, Coke doesn't have snacks, so we're really talking about Pepsi and some of the food players that they compete with. But I don't think it's going to be. We're not talking war here. What we're talking about is there are certain segments of the portfolio, like plain unflavored potato chips or tortilla chips, where you see that more decidedly value-seeking behavior. There are areas of the portfolio where Pepsi leaned too heavily on innovation that just wasn't resonating with consumers, and they're going to go back to the core. So like flanker products on Doritos rather than like the straight down the middle Doritos, a Cool Ranch that people love. So focusing on assortment and, as they call it in the industry, price pack architecture, but making sure that there are packages on the shelf that allow consumers to buy the products at the price point that they need to. And you can do that through volume. You can do that through package size, right? A 10-pack versus a 12-pack on the shelf, things like that make it fit into the budget that a consumer has to spend on a daily or weekly basis.
Hey, Lauren, we really appreciate it. Thank you so much, Lauren Lieberman, Barclays analyst, joining us on Pepsi. Man, I haven't had Cool Ranch Doritos since like the 90s.
Yeah, I'm actually going right now through the Doritos website. I'm astonished at how many flavors of Doritos there are out there.
Sticks.
They got flaming hot queso, hot honey mustard, smoky chili this, and tangy barbecue that, chili limon.
My tummy already hurts.
Your face says
so
no.
My face says no. My stomach already hurts. Yeah. We don't want that. All right, we're going to cut you down to the closing bells. We're about 15 minutes away. Rich Ross, head of technical analysis of Evercore ISI, will be joining us. This is Bloomberg.
Part of the reason why we've rallied as much as we have this year is because we've been sniffing out those rate cuts. But what's interesting is the rotation that we're seeing is exactly what we have seen historically. Tech rallies into the first rate cut, then it consolidates in the 1 or 3 month period. But what tends to outperform are those interest rate sensitive sectors, and actually utilities ends up being the top sector in the 3 month following the first rate cut.
Anastasia, Amoroso, Chief Investment Strategist over at ICapital. A tale of two cities in the market right now, with the Russell 2000 near the highs of the day, the S&P and NASDAQ near the lows. Romaine Bostic alongside Alex Seal. Scarlett Fu joining us a little bit earlier to help carry us to the close. And Scarlett, this is really about that big rotation out of tech and I guess into some of those forgotten names.
Yeah, as much as we're looking at the S&P 500 and NASDAQ decline, you look at the breakdown within the S&P 500, 393 names rising and 109 declining. Of course, it's all the big tech names, so that's what gets everyone's attention. The question is whether this is sustainable past this one day.
I was talking to someone on the street who was saying that it's been 48 days since all Mag 7 stocks sold off at once, and we haven't seen that in years and years and years. And now we're definitely seeing that pretty much on heavy volume and flow also. Absolutely,
yeah, the volume picking up as well. And of course, as we get into the earnings season, and Alex, we talk about the individual moves on the day down right now in the S&P 0.8%.
Yep, you're looking at that, looking at NASDAQ. Tesla, really one of the losers there, down by over 8%. It's hard to know, though, was it triggered? Yes, okay, the robotaxi thing, but were you just waiting for a sell-off, or was there some real fundamental news, for example?
Who knows? I mean, it wasn't it up for like 12 straight days?
That's what I'm saying. Like, it's just like, oh, okay, let's just get rid of it for a second.
Yeah, and maybe it's getting caught up in the downdraft. I don't know. Did you actually think that robotaxi was coming next month?
No.
Okay, I didn't.
That's what I'm saying. But you do look at the chart, and you can see a downdraft right when that headline did break.
Yeah, and enough people believe that it might continue to be a theme that they're like, we'll buy in on this.
Yeah, absolutely. Here, interesting market moves today. We should point out the VIX slightly elevated. Seeing a big sell-off in the dollar and a big rebound in gold, and of course a big drop in Treasury yields across the board. Let's get a more technical look at what's going on in the market with Rich Ross, head of technical analysis over at Evercore ISI. No relation to Rick. Let's talk about some of these technical moves. Because when we talk about the sell-off that we're seeing today, particularly in tech, I'm wondering, if that is really a lot of folks kind of looking at some of those technical measures, seeing that they're a little stretched, and now with the aid of lower rates, at least in the Treasury market, lower rates right now, that was kind of the signal to say, okay, now we find those entry points in the beaten down small caps.
Yeah, I think that's fair. What we've seen is a market that's been driven by momentum. And as we know, momentum cuts both ways. It's driving the winners higher and the laggards lower. And today that band just decides to pull back, obviously. A little better inflation data, little relief on the interest rate front, more than a little bit of relief. That dollar weakens, so you bring some of those economically sensitive laggards, which have been stretched to almost historic extremes in terms of their relative underperformance. You bring those back into play. So I think to answer your question, I think one day does not a regime change make. You don't want to get too far away from the big tech, the quality, the growth, the momentum trade. But by the same token, you do want to get more excited about those stocks and those areas of the market that will benefit from lower inflation, lower interest rates, and easier policy, all three of which I think we've gotten today.
That feels like a buy small caps situation. Is that?
It is a buy small caps, but importantly, it doesn't mean get out of your high quality large caps.
It doesn't mean sell tech, buy small caps.
It does not mean that. And that's what a bull market does. It is the rising tide that proverbially lifts most, if not all boats. And again, this is a uniquely strong bull market. I mean, you talked about it today, 393 advancers. You know, as much as we decry the narrow breadth, be careful what you wish for. Today, breadth expands. It explodes into the stocks that you wanted to work. And what happened? The S&P goes down because the 393 don't make up for the 7 that aren't working today.
Yeah, the 7 that aren't working today is dragging everything down. And you look at the S&P 500's relative strength index, and as a technician, I know that you pay attention to this. Prior to today, it was at 81, which is well above the 70 level that considers it overbought. So now, after today, it's come back down. But how much of this is a knee-jerk reaction versus something that's a little bit more sustained?
I think for now the punishment fits the crime. When you talk about the strength in those stocks, the triple Qs alone up 22+% coming into the day. The Russell 2000, by contrast, 2 days ago was down on a year-to-date basis. So consider that in a runaway bull market with the triple Qs up 22%, the S&P up 17+%, for the Russell to be down year-to-date. So I think those overbought conditions finally come home to roost. You know, stocks are a function of both price and momentum. We haven't seen any evidence of exhaustion in price, but you've seen that backdrop, those sort of extreme overbought conditions in certain cases. A stock like Tesla making it to 87 on the RSI. Keep in mind, Tesla up 50% over in just 1 month alone. So a little bit of a pullback, a little bit of that proverbial pause that refreshes. Overdue, but again, this move is not over per se to the upside.
I wonder if we kind of look to some of the broader sectors here, particularly as we head into earnings season and we get into a lot of big names, primarily next week. I'm going to get the banks, but you know, who wants to talk about banks? But when you get into some of the techer and the sexier names, the Netflixes of the world, like what are the ones heading into this earnings season that you do think has probably one of the better technical setups?
Yeah, look, I think it's one of the things that keeps me so bullish of markets more broadly and those big tech stocks, given their heft in the averages. They're all in an outstanding technical position. Take a stock like Amazon, just to pick a name. Why don't we? It just broke out from a 3-year base to an all-time high. It's a stock that if you go back to the highs in 21, it's up about 8-9%. So for those that think that every stock is stretched like it's 99, it's just factually not correct. Amazon is a stock that, again, it's up mid to high single digits over the last 3 years. It's just breaking out now, both relatively and absolutely. So that is a stock that is absolutely for me. Meta would be another great example of a stock that had been moving sideways for the better part of the last 5 to 6 months after surging. The biggest one-day gain in market cap in January. We've just spent the last 5 months consolidating that move, and now it breaks out again to a new high. Obviously not today, but those are 2 great examples of stocks that are not overextended, they're not uniquely overbought, and those are the names that I would like to buy, amongst others, as you go into earnings season.
What about Apple? So has had like a huge move, right? But is it the kind of stock you want to buy? Like, it hasn't had a sideways move like Meta.
No, but it actually has not of late, because we consider the overt strength. Keep in mind, less than a month ago, Apple was down on a year-to-date basis. Right. And it was sort of I'm not sure what the proper phrase was. So let's avoid the phrase for what Apple was, but the point is it's back in the conversation now. It's a stock that had moved sideways for the better part of the last 12 months in a runaway bull market. So to me, I guess the key point here is that when things break out from consolidation, from well-defined trading ranges, you want to buy the breakout. And Apple is exactly that type of stock. And if I could just make one last point on positioning and sentiment, these stocks are so big. We're talking 7% of the index for whether it's Microsoft, Apple, and NVIDIA, and very few fund managers that run balanced funds can overweight these names. If you overweighted them, you'd have 30% of your stocks in your portfolio in 3 stocks. And went to NYU. That's not exactly a balanced portfolio per se. So I guess my point is that these stocks are perpetually under-owned to a degree.
Let's talk about home builders. They're up about 7.3% today, of course, benefiting from the lower rate thesis out there. Biggest gain since November of 2022. What do you see in terms of the technicals here? Because before today's move, the chart kind of goes like this, and then you go, it's a parabolic move.
Yeah, and again, I think that's one of those great setups out there where you don't need to have regime change out of these large cap winners out of the Mag 7 to go and buy home builders. Home builders, thank you very much, can stand on their own merits. And by that, they've had a pretty weak run, both absolutely and relatively. But importantly, you didn't break any of those major charts. You think about the big names, whether it's Lennar or a D.R. Horton. Yes, they've gone through a tough stretch, but keep in mind, these were some of the great outperformers off the bear market lows. So to me, yes, it's a big move surging off the 200-day moving average, whether it's the ITB, the XHB, the Lennars of the world. But again, this is the beginning of a new move. Maybe it's just a counter trend move this summer, but these are big bull trends that are intact. I would buy today's strength.
All right, Rich, great stuff. Rich Ross, head of technical analysis over at Evercore ISI, helping us count you down to those closing bells. We're just about 1 minute away here, and the trade is looking really interesting here, Alex. We talk about that differential between the broader market, and let's just say big tech, and the small caps, the smaller market here. Biggest outperformance we've seen, Russell 2000 versus the NASDAQ versus the S&P. Since March of 2020.
I think it'll be really telling how we open tomorrow.
Yeah.
Like, is it going to be, okay, we got it, we got that 2%, let's go ahead and buy the dip, or is it going to be, let's see some follow-through selling and really sort of flush that out a little bit?
I mean, I know you poo-poo the banks, but they will help determine what happens tomorrow, especially given how the Russell is so heavily weighted towards the financials.
Correction, the banks poo-poo themselves, Scarlett. That
was really funny. Are we allowed to say that?
Yeah, you just did. Own it. You're good.
I am curious, though, when we do hear from the bank, because obviously a lot of the trade today is kind of macro-driven. Obviously, the CPI report feeding into the Fed. Does that change when we hear from the banks? Because we know they give a pretty good macro picture, at least the big ones do.
Yeah, absolutely. These are all big questions. Jamie Dimon, how does he describe the state of the economy and the state of the consumer, right?
All right, we get the closing bells here in New York. A really interesting day here. We should point out, and I think Scarlett flagged this earlier, yesterday we had about 80% of the S&P stocks were higher on the day, and that led to a 1% gain and another record high. Today, 80% of the stocks in the S&P are higher, yet we have a 1% drop in the index on the day, 0.9% to be precise, largely because of the drag from some of those big cap tech stocks, down 49 points. The NASDAQ composite down more than 364 points, or about 2%. The two bright spots, though, you're going to find that in that sort of more cyclical and economically sensitive space. Dow Jones Industrial Average basically up about 0.1%, but a 3.5% gain on the Russell 2000, 2.5% on the S&P 400 mid caps, and Dow Transports, guys, up about 2% as well.
Advancers overwhelmed the number of decliners, both for the S&P 500 and the NASDAQ composite. The NASDAQ composite down almost 2% on the day, and of course we're waiting for the numbers to settle. But the number of advancers, 2,455. The number of decliners, 721.
Wow.
Pretty telling. All right, there is the IMAP for the S&P 500. It's a pretty mixed picture overall, and that's because the smallest sectors are seeing the biggest gains. Real estate investment trusts, utilities, materials, they're doing the best, all gaining at least 1.4%. On the downside, all the big cap tech names, right? Infotech, communication services, consumer discretionary, they're all the big drags, and you can see those group each down 1.5%.
Well, no doubt you have utilities and real estate stocks doing well, in part because yields are much lower, particularly on the front end. So 2-year yields down by 11 basis points, and then you go to the 10-year down by about 8 basis points. So you are seeing sort of that bull steepening in the curve, more buying on the front end and the back end, and that curve gets steeper. We've been waiting for that trade to really wind up playing out. Bill Gross weighing in on X, saying that the 2-10 yield spread's now at negative 31 basis points. It's headed to negative 10 basis points as the Fed does cut rates. It says the curve is disinverting. You own the 2s, not the 10s, not the 30s.
All right, we go back to what the equity happened in the equity market today. Some big movers out there. Home Depot, Berkshire, Uber, some of the biggest gainers on the day. Bailey Lipschultz joining us right now to walk us through those gainers. Jess Menton also joining us on set to walk us through the decliners. But of course, we start with the winners.
Start with the green.
Yeah.
That's where it's at. And you had mentioned small caps outperforming. Really strong day with real estate. So real estate stocks having their best day in over a year. After that CPI print, want to call out Builders First Source. They're operating in that space, but pretty much any company exposed to real estate, whether it's home improvement, whether it's making homes, whether it's selling homes, outperforming this morning. Maybe those interest rate cuts are going to play out. People can renovate their houses, maybe even buy a new house.
Even buy a house, maybe?
You know,
so we don't have to live in a cardboard box alongside Central Park?
Sure. I mean, that's what you're saving for. I mean, you know, it's I mean,
that's how you save money.
What?
It's tough out there. Well, it's tough out there for Tesla, which I will leave to Jess, but I will call out that two stocks that outperformed, Uber and Lyft, this coming because of potential delay for robo-taxis, maybe actually will benefit these companies. They are beaten down, though. When you look at a Lyft chart, actually, please don't if you're an investor, just because really has not come anywhere near some of those peaks that they saw.
I'm kind of for the robo-taxis. I mean, I feel like the last few Uber drivers I had, you know, I think they're like Mario Andretti or something. It's like,
this will be an improvement.
Yeah, I mean, it can't be any worse. I'm usually just in the back seat with my head down, trying to have to look out the window.
I like my guys. I've had no problems. Maybe it's a Brooklyn thing. What else are you looking at? So you were talking about the home builders, but also a Builders First Source?
Yeah, Builders First Source.
I don't know that stock.
So they make and sell different things like vinyl siding and helping with windows. So it's kind of goes into the whole, if you're not a homeowner and want to make home improvements, you're buying products that they're making, or also if you're building a house, they're going to have some pretty strong B2B sales in terms of that. And we also really are just kind of calling that out because it's the top performer in the S&P 500.
The home universe.
Yeah. And one company, though, that rallied today, MicroStrategy, announcing 10-for-1 stock split. It seems like these are never going to end. So stock ended up.
Now, how does that work? Does that mean the valuation goes up by 10?
Yeah, it depends who you talk to. If you have laser eyes on X, and you probably find
I was
some
a little
weird
confused as to why it would rally on the back of that.
Bitcoin.
But I guess the psychology of investors.
People like smaller stock prices. We saw Nvidia roll it out. This will take place in August. Stock closed at $13.58, so 10-for-1 cuts that down to $135. But did rally 4%. Bitcoin had been outperforming the broader market in a down day, so I guess maybe there's something bullish there, but I don't know how if you cut more slices into a pizza, it makes the pie bigger. But
it depends on your stomach. Okay, let's go to Jess. You were looking at the decliners, of which there are also many to choose from. What do you got?
Right. Well, I'm going to start with Tesla because Bailey did bring up what was happening with Uber and Lyft rallying on the back of the news that Tesla did delay those plans for its robo-taxi from August to October. So when you look at that stock, Tesla's down 8% today, worst day since January 25th. It actually had been on quite a tear because it was actually the worst point decliner in the S&P 500 in the first half of the year, but it had rallied about 44% over an 11-session span. Of course, that did end today, and it lost about roughly $60 billion in market value. So that's the flip side of, even though you're seeing Uber and Lyft, you know, obviously winning on this type of trade right now, but unfortunately Tesla's on the other side of that because obviously it's going to be a competitor, and if it's going to delay those plans for its taxi type of...
Now, just to be clear, so they said they're delaying it to August, but this is just kind of the announcement.
To October.
I mean, to October, right. But this is just the announcement.
Right.
Like, they're not putting a robo-taxi on the street in
No.
October.
They're going to talk about
I'm confused.
There's still more news that we need to have.
Yeah, so if the announcement's delayed by 2-3 months or whatever, I mean, why is the sell-off?
If you are a Tesla shareholder, you buy or sell based on what Elon Musk says.
But also, isn't this just a point of
Seems like a sound plan.
If your stock has run a lot, it's not going to take a lot for it to sell off. Like, is that also maybe a takeaway that we can get from that, which is kind of also maybe a setup for the airline stock, so that had a fundamental reason for selling off.
Right. I know you were talking about when it comes to revenge travel and if that was some of the reasons, because Delta is the first airline, of course, to report this earnings season. We'll have United and others coming in the next couple of weeks. But when you're looking at this, it was more, you're still seeing strong travel demand there. You're still seeing business travel also strong, but it also has to do with the capacity issues if you're looking at the year-over-year periods. And so that's something that their CEO talked a lot about and how they're trying to kind of mitigate that. But I feel like when I'm going and I'm still paying for flights, they're still pretty pricey, and I still find them to be pretty expensive when I'm traveling.
Yeah, what was Ed Bastian talking about? He's talking about heavy discounting. I was like, dude, heavy? Like, I think his version of heavy is different than ours.
We're just going to the wrong place. We're in the wrong class of plane, and we're going to the wrong places.
I am curious, though, but in all seriousness, though, he did talk a lot about costs.
That's right.
Being higher. And we spoke to Sheila Kahyaoglu earlier, and she kind of dismissed that, saying that they should be able to get that under control and deal with margins. But was that part of the reaction?
Yes, it was. And if you look at also when it comes to other airlines beyond that, if you're looking at the passenger airlines in the S&P 500, down about 3% today. It's worst day since actually the beginning of April. So you are seeing that more broadly, not surprisingly, weigh on those other airlines as well.
We talked about discounts. My favorite place to go to is Costco. I mean, to look for those discounts, but I end up spending a lot more because the price point of everything is at least $10.
Wait, don't you have those giant things of lotion?
Yes,
like face lotion, like oil of. I see. It's very horrifying when I found this out. Go ahead. Sorry.
Horrifying. So they announced that they're increasing their membership fees, which is something analysts had anticipated, and it was seen as good news yesterday when the news came out.
Yeah. Well, D.A. Davidson actually came out today and was talking about, well, why are you seeing it sell off after we had an initial reaction that was higher on the news this morning, especially in pre-market trading, and they were saying usually when it comes to these types of announcements, you do see the stock historically end up declining on that. But it's been a while. It's been about 7 years since the last time.
It's kind of a sell the news, because I feel like people have been talking about this for a couple of years, like saying they're going to do this, they're going to do this, and then when they got the new CEO, everyone said it's coming, right?
It's coming, right?
Yeah.
Well, they held off on it for a little bit because of inflation concerns, but you go from those gigantic shampoo pumps to the little ones that they offer at hotels. They are not doing that anymore in New York starting in January. This is terrible news for anyone who gets their supply of little shampoos from hotels.
Speaking for a friend, right?
Speaking for a friend, of course.
Assuming that one might go and steal all the tiny shampoo bottles from hotels, this is a big bummer.
It's like an episode of Friends where Ross does that. He loads up on everything.
And then she has like the big. Anyway, but it is a real thing, and it is very
exposing
upsetting.
us all.
But I've always seen the big pumps in hotel rooms now, like in the shower, like the big pumps with the shampoo.
Yes.
I don't see the little bottles anymore.
Well, I mean, up until now, New York was doing it, and I think a lot of other places were transitioning to the big pumps. But the concern here in New York is that people might not want to use. First of all, it's difficult to clean, but also people might not want to go use the big pump because other people have been touching them. So now they're gonna change into like a little ketchup packet.
For a friend.
Look on roommate's faces.
Other people touched it, but you're in a shower, so the whole point is to get clean. So it doesn't matter.
Also, like you're also in a room that someone just slept in, but
remains over it. Look at that reaction.
Where's the line?
All right, guys, thank you so much for helping us walk through the gainers and losers today. Really interesting day in the equity market, given the major indexes levels and the actual gainers that we did highlight here. Our thanks to Bloomberg's Bailey Lipschultz and Jess Menton. And that does it for, no, we don't have a simulcast today, right? But that does it for us for now.
All right. Coming up here, we're going to talk a little bit more about President Biden, set to have a press conference tonight, a solo press conference. And of course, everyone's not so much interested in policy, but how he performs. A discussion about that and what to expect after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day, particularly when you put it up against what we saw yesterday. You pointed this out earlier here. We had a broad-based rally yesterday with about 80% of the S&P stocks higher. Believe it or not, we kind of had a broad-based rally today. It just didn't actually translate into actually broad-based gains. About 80% of the S&P stocks were higher on the day, but the big drag of big tech, that was not enough for the aggregate market to do anything. You see that really reflected in the NASDAQ 100, the big laggard on the day, down about 2.2%. But look at the differential there with the Russell 2000, a 3.5% gain in the Russell, the best day of the year for that index. But that differential here, 5 percentage points, we haven't seen that type of differential between the small caps and the big caps going back to the pandemic, the start of the pandemic, March of 2020. A lot of that had to do with the big drop that we saw in yields, down about 11 basis points on the short end, a sell-off in the dollar as well, Scarlett. And you wonder if this has changed the complexion of what people are going to buy and what they're going to sell.
Yeah, everyone was waiting for so long for the broadening out of the equity market strength, and we finally get some, but the indexes show deficits. Now, one big reason why is because of what happened with the Magnificent Seven. Let's start with Tesla, which was the worst performer of those Mag 7 names, losing more than 8% on the day. It was the most active company stock by value, and it had gained earlier, but Bloomberg reported that Tesla is now delaying its planned robo-taxi to October by about 2 months. So the initial plan was August 8th. And of course, this is the unveiling of the robo-taxi. It doesn't actually mean that it's going to be on the roads. Optimism about the robo-taxi and, of course, just things that Elon Musk was kind of hyping had led to an 11-day rally for Tesla, which added about $257 billion to its its market cap. Now, Romain mentioned small caps. Let's take a look at a small company here. Lantheus Holdings, LNTH, up by almost 17%. This is a fresh record high, and it builds on yesterday's 37% surge that a Medicare payment proposal is seen as a positive for this company, which makes diagnostic medical imaging products. But when you put it all together, our top story this hour is how the latest inflation reading has got to be welcome news for private equity. Because the industry is heavily dependent on debt, the current higher for longer rate environment has been painful, with buyout firms using creative financing to defer interest payments, unable to exit their investments profitably. Even with assets growing, we are seeing lower returns for funds and disgruntled pensions, insurers, and other investors that put their money into PE funds. We're a long way away from the cheap money era, but if the Fed starts cutting rates meaningfully, then perhaps it'll be easier for PE to exit their investments, raise money to start the cycle all over again. Romain?
The macro story is certainly dominating for the day, but quite frankly, it's been dominating all year long. A lot of discussion here about the outperformance of the U.S. economy. That's been front and center, but investors divided on how much further that narrative has to run.
And I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were.
The pendulum is swung back. We're not focused on China. We're not focused on emerging markets. U.S. equities are outperforming, and even if it's just one sector or a couple companies, it matters.
Some of the great voices we've had on this program over the last few days and weeks. Another one joins us right now, Whitney Baker. She's the founder and CIO of Totem Macro, a boutique global macro investment firm, formerly ran the EM shop over at Bridgewater. Thank you for being here, Whitney. There's been a lot of talk about how there really is no other place for investors to go other than the U.S. Do you buy that?
That's been a story for 15 years and obviously post-COVID as well. I think it sort of behooves us to zoom out a little bit at what's driven that. And really, there's been two things, both for the 15-year view, this whole cycle, and also post-COVID. Those two things were more money printing in the U.S. than elsewhere, and basically better economic growth and better earnings. And some of that earnings was obviously the secular nature, secular growth over cyclical growth that tech benefits from in this cycle. But some of it is also just the better job, basically fixing the banks and kind of getting the economy off the ground when the other global economies couldn't. And so the consequence of that is a lot of money printing has driven asset prices up. Nominal GDP has kind of stagnated down here, but been better in the U.S. than elsewhere. And you've got this huge financialization, essentially asset inflation instead of broad nominal growth, because the money is feeding into that channel, whereas credit has been basically deleveraging this whole time. And that just went into turbo drive post-COVID. And both those things are ending, basically.
Why are they ending?
Okay, so you have to zoom out a little bit. Obviously, we know that the U.S., if you think about the big picture, it's the world's biggest debtor now. That debtor position, what I mean is they run perpetual current account deficits vis-a-vis the rest of the world, and also on the fiscal side is a big contributing factor to that. What that's meant is that, it's not a news story that Asia has essentially financed the U.S. all of this time. But just for context, the U.S. debt position versus the rest of the world was about 10% deficit or total debt stock, net debt stock in 2007. Over the course of this cycle of all of this Asian buying of U.S. assets, really sucking, essentially U.S. has been like a magnet sucking in every dollar of cross-border capital this cycle. And so now the U.S. owes the rest of the world about 70% of GDP, which is, well above what most emerging markets reach. And that's sort of our area of expertise. At the top of their balance of payments upswings. So the reason it's ending is it's not the reserve currency argument. The focus is entirely in the wrong place. There hasn't been a reserve currency bid for U.S. assets since 2015. What's happened for the last 10 years is that Japanese banks and Asian real money, including Taiwanese life insurers, Korean pensions, Canadian real money, those investors have channeled all of their assets into the U.S. and essentially financed this cycle because it was the best place to be in that environment. And so they're now essentially balance sheet constrained to keep doing that.
So your thesis that American exceptionalism is ending really goes to this idea that there's a big regime change. Has it ended already, or it's going to end? I want to get an understanding of how long this transition period is.
I think that we're in recession already. I think that in the U.S., I think that it's a shallow recession because it's basically a little bit of consumer services, business services coming down and offsetting that this structural investment drive and things that we've all talked about, climate change, militarization, re-onshoring, all that stuff. Meanwhile, the rest of the world just had a big recession because when rate hikes happened post-COVID, they immediately flowed through to the rest of the world because there's floating rate debt there, and they just didn't flow through in the U.S. until very recently. So the U.S. is basically going into a shallow recession. So the relative growth supremacy is going elsewhere. The nature of that growth will be much more cyclical than structural. And then obviously, like in terms of preferring tech over other sectors and drivers. And then really the main issue is that the money printing is now ending for a variety of different technical reasons. For the next 6 months or so, there's really no money printing. And that has been the thing in the last year through April that's really driven the U.S. stock gains.
I am curious that when you look at economic conditions in Asia, particularly given some of the policy decisions that they've made over there here, are we looking at a potential upswing? Because I think a lot of people were certainly banking on that with China and even some of the other countries in North Asia, this idea that there was going to be this upswing, this valuation. That didn't materialize, at least not to the strength that some people thought earlier this year. Is that kind of a pipe dream? Do you find any sort of fundamentals to support that?
Yeah, so no, I don't think that's going to happen. North Asia and the U.S. have been the two engines of economic strength this cycle. The only places in the world that have actually leveraged up for the last 15 years, Europe and the rest of the emerging world, they've all been trying to get their balance sheets in shape. And so the issue you have is because of all of this money printing in Asia, low rates, a lot of that channeled into U.S. assets, sure. But on the other hand, a lot of it got channeled into domestic debt and property bubbles. And that's what you're seeing really across the board, but particularly with China. They're prioritizing their currencies over easing to deal with that. And so you just have this balance sheet challenge.
Just real quickly, we're almost out of time, but is there any pockets of EM right now that you do find attractive relative to the U.S.?
Yeah, absolutely. I mean, EM is the opposite side of this story. The way that BRICS was the sort of leadership group of the last bubble, FANG has been the leadership group of this bubble. And all of this basically argues for a lot of dollar, sort of a dollar unwind, right? The currency is very strong. And all of these flows have come in and supported U.S. assets. These financials in Asia are going to have problems holding those assets because of a combination of things, but mostly because they're also doing their own QT. So there's money contraction basically across the board. And there's carry unwind now in the U.S. because U.S. dollar has become a carry trade. So that unwinds with Fed cuts and it goes elsewhere, mostly into economies that are very cheap, with markets that are cheap, with economies that are troughing out and rebounding. That stimulus will help them get off the ground, and so it will further support their assets.
Whitney, really appreciate your joining us today and giving us your perspective on things, the long-term view. Whitney Baker is founder and CIO over at Totem Macro. We've got much more ahead. This is The Close on Bloomberg. A high-stakes moment for President Biden this evening as he prepares for a news conference at the NATO summit. Joining us now from Washington is Bloomberg Balance of Power co-host Joe Mathieu. So President Biden will be speaking not off a teleprompter, but answering questions. It'll be live. I feel like we've been here before with this is going to be a make or break it moment, and it hasn't been.
Yeah. Well, look, you're asking the right question. Is this a test or is it the test? Might be another way of asking it. And I'll tell you what, over the course of 2 hours today on Bloomberg TV and radio, every Democrat and Republican analyst that we had, including our own Bloomberg political contributors, Rick Davis and Jeannie Sheehan Zaino, had all drawn the same conclusion. They don't think tonight matters. They think this is already over. And it's simply a matter of time and exactly how the Democratic Party is going to go through this process of convincing Joe Biden that he will not be the nominee in Chicago next month.
What does the White House think, Joe, and why go through this with this press conference now?
Well, look, first of all, it is his job. Let's acknowledge what's really going on here. It's the 75th anniversary of NATO. They had a big summit. He had a bilateral meeting with President Zelensky today announcing new aid for Ukraine, a bilateral with the new prime minister of the UK. So in any world, this would be appropriate and required for the president to stand and answer questions from reporters. But is this going to help determine his political fate? That's a very different question right now. There's been extensive reporting on the fact that many Democratic lawmakers have already written their statements asking him to drop out. We're going to find out about that as soon as tomorrow, because out of respect, they have been waiting for these 31 world leaders to leave the United States, to wait for the politics until after the news conference. So tomorrow could be an important day as well.
Did anything actionable come out of the meeting between the president's top aides, his campaign proxies in many ways, and the Democratic senators?
I wouldn't say actionable, although it's interesting to see some of the frontliners who were not there. And we did get our first senator today, Peter Welch of Vermont, a Democratic senator, calling on Joe Biden to step down. And he adds to a chorus, of course, on the House side. But it's also the straddling of the lines. Hakeem Jefferies today saying that he's behind Joe Biden as long as the conversation is going. That's a lot different than saying no matter what. Nancy Pelosi yesterday saying she's still waiting for him to make a decision. And Joe Biden, of course, watching television, was probably thinking that he already did. But this is the kind of limbo politically that the party is in right now.
And just remind us real quickly, Joe, that press conference scheduled to start when?
They've moved it back to 6:30, Romaine. There's a chance that it will start later than that because we are on Biden time, as they say. It wouldn't be unusual for this to start late, but the official start time is 6:30. We're going to bring special coverage, and we'll let this breathe. You'll see the whole thing and hear the whole thing on Bloomberg TV and radio.
You can also get a preview of that right around 5 p.m. Washington time, where you can catch Joe Mathieu alongside his co-host Kelly Lyons over at Balance of Power right here on Bloomberg Television. Kind of interesting, Scarlett, that he's moving back the time, because didn't he say after that debate that he shouldn't be staying up as late anymore?
Yeah, but 6:30 is still 6:30. We're not talking about the 8 p.m. bedtime, sorry, it wasn't bedtime. It was 8 p.m. not going to be doing any more,
Gotcha.
presidential work at that point.
Of course, potentially a very important press conference later tonight. When we return, though, we're going to take a closer look at private equity and a closer look at Ari Emanuel's big bet on the UFC and a big bet on turning himself into a media mogul. This is The Close on Bloomberg. All right, let's take a look at this day in history. July 11th, all the way back in 2016, Hollywood super agent Ari Emanuel, with the backing of private equity firms Silver Lake and KKR, purchased the UFC Mixed Martial Arts League for about $4 billion. It was a stunning valuation for the UFC, which just 15 years prior had been bought for a meager $2 million. But it was an even bigger deal for Emanuel and his ambitions to be a true media mogul. Those ambitions, they began to bear fruit back in 2012 when Emanuel and the then executive chairman of his William Morris Endeavor agency sold a minority stake in the business to private equity firm Silver Lake and then used that money to go on an acquisition spree. That spree, it included the landmark 2014 deal that merged William Morris with sports agency IMG. In the next few years, WME acquired all or part of the Miss Universe organization, the Barrett-Jackson car auctioneer, and the business providing sports betting data, among others. Now, while competitors often question Emanuel about how all these pieces fit together, he insisted they would give Endeavor more power and give his sports and entertainment talent more options. The mashup of WME and IMG reorganized in 2017 with the parent company renamed Endeavor. And after laboring for years to go public, Endeavor finally IPO'd back in 2021. Though, after all that effort, the corporate structure that Emanuel built is now being unraveled. Just last year, Endeavor separated the UFC and World Wrestling Entertainment part of the business into a separate public company called TKO. And as for Endeavor itself, the remaining structure of the agency is, well, going full circle back to Silver Lake. Silver Lake finalizing plans to take Endeavor private. That deal expected to close by the first quarter of 2025, and that will see Silver Lake pay about $5.8 billion in cash, valuing Endeavor at $13 billion.
I love that round trip, going straight back to Silver Lake. Let's stay on the private markets here, because Pete Stavros of KKR has been warning that creative wizardry may be obscuring danger signs in that industry. He said on things like NAV loans and margin loans, it's just additional leverage. And if things go against you, you can have a problem. For more insight on private markets and the outlook for private equity, let's bring in David Layton. He is CEO of the Partners Group. David, clearly there's a lot of concern here about some of the creative financing that the industry has had to take on because of the higher for longer rate environment. How do you see that playing out as we anticipate the end to higher rates and the start of a rate cutting cycle?
Well, if you look at investors in private markets, they have become used to getting about 25% of their commitments back in an average year. Okay. In 2023, that level of liquidity fell to about 10% of their commitments, and investors have been feeling the crunch. And so you do see some creativity from certain managers to find ways, manufacture ways to create distribution activity back to clients. And I largely agree with Pete and his sentiment that it's just leverage upon leverage, and investors need to be very careful about the use of such facilities.
Yeah, investors need to be very careful. At the same time, leaders in private assets like Scott Kleiman of Apollo Global Management have made clear that things are not going to be okay. Fewer realizations and lower returns are on the horizon. When we say on the horizon, what kind of time frame are we looking at here?
Well, we have seen a pickup in activity already this year. We estimate that investment activity will be up about 10 to 20% this year versus last year. At Partners Group, we invested about $9 billion in the first half of this year, and that's an uplift of 55% versus the same time period last year. And so I do think that you're starting to see more investment activity coming across the line. We have financing. It's much more robust today than it was just a few years ago. Valuations have come down from about 12 times on average historically to about 11 times today. Mm-hmm. And so I do think that the industry is poised to see more activity next year than it saw this year.
Give us a sense as to where that money goes. I was looking at your press release that Partners Group put out a little bit earlier today, the latest update on assets under management at around that $149 billion mark. But we talk about a client base, at least on the institutional side. Let's just split this up. A client base that to a certain degree might be tapped out. A lot of them are already bumping up their own internal allocation limits. Some of them are still waiting on returns of capital from previous vintages that might constrain what they can do now. Where is the growth going to come from?
Yeah, I anticipate going to add about $1 trillion of new assets within the private markets this year. Okay, capital formation within the private markets remains quite robust. Okay, we see capital formation here that's about equivalent to what we were seeing in 2018. Okay, maybe not the highs of 2021, but a reasonably robust environment for new investors to come online. The private equity industry has really been driven by one big wave or one big trend over the last 30 years. Mm-hmm. And that's been the shift of allocations from institutional investors towards private opportunities. Okay, your average institutional investor today has about 10.5% of their portfolio in private opportunities, and that has created this $15 trillion asset class that we have today. Now, as we look moving forward, one of the things that this rate hike cycle has told us is that 10.5% allocation from institutional investors probably isn't going to 15, probably not going to 20, at least not in the near term. But there is structural growth that remains very robust within our space. Okay, high net worth individuals are increasingly coming online and starting to consume private markets products. Okay.
I'm just curious though, is that going to benefit the more pure play firms like Partners Group and some of your direct competitors? Because we've seen a lot of evidence of family offices basically setting up their own kind of private capital operations within their own offices. We've seen some of the insurance companies doing something similar. So they're creating their own alternatives for investments where maybe they don't need you. Is that a concern?
Mm-hmm. Well, what we're talking about here is not very wealthy families with their own family offices. What we're talking about is high net worth individuals that are coming online more fully. And so we raised $4.7 billion in the first half of this year through semi-liquid vehicles that are built to meet the needs of individual investors, okay, smaller investors. We raised $11 billion in the first half of this year. Okay, that's up 39% versus the same period last year. There is real structural growth that's coming online from this segment of the market. And there are entire segments of the value chain of many industries that you can only access today by investing into private portfolios. And so you're seeing individual investors that want more of a piece.
David, really appreciate your joining us today. David Layton is CEO of Partners Group. And it goes to that idea that for years now, the private equity, private credit industry has been talking about democratizing access to these markets.
Well, and they have to, right? I mean, that's where the growth is going to be. I mean, like I said, and you're seeing it, right? I mean, how much interest have we, when we talk to some of these wealth managers and some of these third-party intermediaries,
assets,
they talk, this is what people want. Because look, I mean, think about it. What are you getting in public markets right now? It's a Mag 7. And if you want to invest beyond the Mag 7, or at least in the companies that have real growth potential, a lot of them are up in the private space.
Or they want 6% in, treasuries and something safe like treasuries and just chill.
Yeah, but that's not a good spin.
All right, let's take a look at markets, because I think you need a little bit more than spin to explain what happened here. A lot of red arrows when you look at the big cap indexes, the S&P 500, the NASDAQ 100, but beneath the surface, more gainers than decliners, certainly for those two indexes as well, certainly for the NASDAQ composite, as there was a big rotation to small cap stocks and sectors that had been ignored.
I love days like this when you get this huge sort of dichotomy here. And then even within the S&P, real estate up 2.6%, tech stocks as a group down 2.6%. And then you have kind of all the superlatives, worst day for the NASDAQ of the year, best day for the Russell for the year.
Home builders up 3.7%, just another day. I mean, all of it resting on this idea that the Federal Reserve is going to move ahead with interest rate cuts in September. I mean, stop me if you've heard this before, right?
Is Jay Powell just like chuckling at all this? And you're like, I ain't cutting rates, dude. What are y'all talking about?
Well, it's not happening in July, is what he's thinking. The 10-year yield going down to 4.20%. This is the close on Bloomberg.
Bank earnings kicking off tomorrow. JP Morgan, Citi, Wells Fargo, all set to report before the market opens. Expectations are high. What will those banks say? Alison Williams of Bloomberg Intelligence joining us right now for a preview. And Alison, I mean, these banks are already pretty transparent, whether voluntarily or involuntarily here. What do you think we might learn tomorrow that we didn't know?
So I think the key things we'll be looking to learn about, the one interesting thing we've seen in industry data is a big pickup in C&I loans exiting the quarter. And that's certainly nothing that we've heard from the banks. We've heard loan demand's been pretty weak. So is there a pickup in commercial loan demand, or is there just something a little bit funky in the data? And then looking forward, those investment banking fees, there's a lot of talk about these fees. They're really probably most meaningful to Morgan Stanley and Goldman Sachs, but really Jefferies and some of the smaller players, I think, have the big leverage. But everyone's wanting to hear, is there more pickup to come in the second half, especially for IPOs and M&A? Debt issuance has been really strong this year, and will that continue? On the trading side of things, I mean, as you said, it's no secret that the equities markets have been strong, and the issuance we have had on both debt and equities helping that secondary trading volume. So we do expect to see a leg up in equities trading, credit trading helping FICC, rates trading perhaps not as good. And then on the net interest income side, JP Morgan has already increased their guidance for net interest income. They did that at Investor Day. Wells Fargo will be looking to see if they, either move their range or change their guidance, because they've stayed consistent. They're expecting 7 to 9% decline in net interest income this year, and we think that they'll come on pace at least to be at the higher end of that range.
Okay, so net interest income is expected to drop, but it does come off a pretty high base, certainly after a pretty big surge last year. What we've noticed in recent years is that or recent quarters, I should say, is that after the earnings reports come out, the big banks start announcing plans to sell debt. They're raising a lot of cash. And of course, they're doing so in anticipation of these new capital proposals that are now going to be tweaked. What does that do in terms of the fundamentals for the financials as investable securities?
Well, I think, the big focus for the banks with regard to the coming capital rules, at least for these big six banks, is if their risk-weighted assets are going to be significantly higher and they have to hold a lot more capital, what does that do at the end of the day to their structural returns to their business, right? It's just mathematical. If you have to have, sort of that bigger denominator. And then what does that do to, return of capital? And so we had some incremental news with regard to the requirements. So there's the stress tests that take place every year. Based on those tests, most of the bank's requirements are going up in the fourth quarter. Citi is the exception. So that's, sort of the annual news that we get for the banks. But really, we're waiting for those Basel III Endgame was what they were called, the rules when they came out last year. But now we're expecting those rules to be changed. Powell has signaled that. And the latest news we have on that front is it sounds like the Fed is ready, but really has to coordinate with the other agencies to figure out what those final rules are going to look like.
Got it. Alison, really appreciate it. Alison Williams of Bloomberg Intelligence giving us an idea of what to look ahead to with bank earnings starting tomorrow. We're going to stick with banks right now in our Muni moment because with those earnings starting tomorrow, one metric that investors will likely be looking at is the underwriting business, in particular when it comes to Munis. Citi, of course, exiting its public finance business, while Bank of America, RBC, and Jefferies, they're all sticking with it and perhaps getting the chance to add talent to those divisions. Joining us now is Eve Lando. She is portfolio manager for Thornburg Investment Management. Eve, great to speak with you. Just early, very, very quickly, do these banks make a lot of money from the Muni underwriting business right now?
I'm afraid I don't know exactly how much they make, but from Citi exit, as you mentioned, it doesn't sound like it's been a very lucrative business in the past decade or so. However, it is a relationship business and things could change and they should change. And with a lot of talk about infrastructure needs in the US, this could be a booming business. At least we hope so.
So when we talk about the momentum there, Eve, is there sort of a critical point that you're looking for where we're going to get more clarity on how much further this continues? Because we're already tracking, I know something like 40% higher than where we were last year. I know we're only 6 months through here, but if that continues, that's a pretty phenomenal run.
That's fantastic. Yes, 30% is great. More is better. And still with this increased issuance, we are still having insatiable interest in anything tax exempt. Part of it is because we've had a couple of years of under issuance, if you'd say, but also as investors should know, other fixed income markets have doubled, quadrupled in size. The Muni, outstanding Munis, we are still at the same 4 trillion we were 10 years ago. So supply demand is truly out of whack for my market.
And there are a lot of entities issuing debt. And we see that particularly in the education sector. It seems like every time I'm looking for stories on the muni bond world, you have some small private college debts trying to raise money. I know why they need to raise money. What kind of demand is there for that debt?
Interesting, yes. There's some bifurcation on kind of higher yielding names, and especially small schools, small colleges and universities with decline in enrollment, with smallish endowment. I don't think they're finding as much interest in the market as they used to. They still able to place the deals, but it is coming at a higher cost. One of them is just going after insurance. Municipal insurance is somewhat back in vogue, especially for names like smaller colleges and issuers with somewhat stories connected to them.
I have to ask you, Eve, about the interest rate environment, particularly coming off of today's CPI report and the expectations that we might start to see Fed rate cuts. Part of what has aided some of the returns in the municipal bond market was that they'd offered pretty healthy returns, at least relative to what you can get elsewhere. Does that change if interest rates come down?
Yes, and I do hope that the Fed is not touching anything this year, that we will have a very reactive Federal Reserve, not proactive. So I am hoping that nothing will change this year for the muni market and the yields that we've seen. And our relationship with Treasuries, of course, is a big part of that.
All right, Eve, got to leave it there. Really appreciate you taking time for us. Eve Lando, portfolio manager over at Thornburg Investment Management. Our Muni moment here on the day, a pretty critical day when you think about it, Scarlett, particularly given at least the speculation about this being an inflection point for interest rates. And of course, as she said here, a lot of municipal projects need to get off the ground at some point as well that should aid new issuance.
Yeah, all these small local governments that need to move forward with infrastructure. I mean, I think of what's just going on in New York and the Gateway Tunnel and everything else.
We got quite a few infrastructure projects we need to get done here.
If you can't get federal grants for it, then you have to raise money in other ways.
Yeah, and it'll be interesting to see what the appetite is by investors. Obviously, you're getting 5-6%, and obviously most of these are tax exempt, so that adds an extra compelling. But when those yields start coming down, you get more competition from equities, from other parts of the fixed income space. What happens then?
Absolutely. But we'll see if it's actually we're at an inflection point. It's been said before, and it turned out to be a false dawn. Absolutely.
Here, as we wrap up a pretty wild day here, we want to push ahead and set you up for some of the potential big market moving events tomorrow. So stick with us. We'll be back in a second, right here on The Close.
All the Magnificent Seven stocks declined today, none more so than Tesla, whose stealth rally hit a wall, falling for the first time in 12 days. Now, after closing down 8% in its worst day since January 25th, the stock currently extending its decline in after-hours trading. Bloomberg Technology co-host Ed Ludlow has more on what we're watching out for when regular trading resumes tomorrow. Ed, what will you be watching for?
Well, between now and the open, a response from Elon Musk to our reporting, which is that Robotaxi unveil, Robotaxi Day, is delayed from initial scheduled date of August 8th to sometime in October. What sources told us is that they want to have more to show. They want more prototypes to be able to demo. But one source told me also that Elon Musk directed Tesla's design team in the last couple of days to go back and rethink some of the design aspects. So, it's a really interesting move. It comes from a high bar, right? RSI was in the high 80s before we broke the news. It was an 11-day winning run. So that could be part of the story of a sustained sell-off. But a lot of the valuation and a lot of the concern from investors is the future of Robotaxi. And that's why we look toward the open and Tesla shares. And as we always do, I wrote to Elon, I asked him to comment, I invited him to do an interview. We haven't heard from him. Maybe it will happen.
Ed Ludlow there out there in San Francisco. A few other things that investors are going to have their eye on here over the next 24 hours. Of course, a lot of people still focus on politics. Scarlett, that press conference with President Joe Biden scheduled to start at 6:30 p.m.
And you stress the schedule because he has a habit of running late. And of course, this is a live event. It comes on the heels of NATO summit, the 75th anniversary. But this will be a chance for everyone to once again gauge his fitness at whether he can handle these live back and forths with the press.
But you heard Joe Mathieu just a little bit earlier on this program. According to his reporting, he's saying that a lot of Democrats are already ready to move on. Of course, let's get back to the things that are really going to move the market. Earnings season in full swing with the big banks starting tomorrow morning.
JP Morgan, Citigroup, Wells Fargo, all reporting earnings before the bell. It'll be something that we all focus on. And of course, it sets the tone for the rest of earnings season. Certainly sets the tone for Goldman Sachs and Morgan Stanley with their focus on trading and capital markets later on.
And I always like to hear some of the commentary, particularly from Jamie Dimon, Jane Fraser, and a few
Fortress
others
balance
about
sheet,
the macro issues, and where they think the economy is going to go. Always a decent read. And as we get the comments from the economy on them, we do get additional economic data, including PPI.
Wholesale inflation. The encouraging news is that consumer inflation came down. In fact, there was a decline in the headline number month over month. So we'll see how PPI plays out. But if it continues with this idea that it comes in weaker than expected, that's going to fuel the dovishness in the market.
Another read on consumer sentiment, the UMich survey out at 10 a.m. And overnight, we are expected to get some updates on China's trade balance.
Exports, imports, all of that.
That does it for us here on The Close. We'll be back tomorrow for all of your market moving coverage, but stick around. All your political coverage about to start at the top of the hour with Balance of Power right here on Bloomberg.